Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth. With you this afternoon, the 29th of May, market closed. Welcome to our May 2024 update. Allow me to share the screen and we will begin to discuss what's going on. Okay, so the title of this talk, as you can see here, Higher Interest Rates for Longer. That's the conversation that we're having today. Let's proceed. A little humor here to start the conversation. I thought this was really cute. Maybe things have gotten a little too far, and maybe things are a little bit ginned up, a little overcooked. We'll see. Okay, macro backdrop. Interest rates are clearly looking that they're not coming down so quickly. That's a nice way to say that they are stickier. This particular chart from our friends at Apollo suggests that even if they come down somewhat in the next 5 years, interest rates are not going back to where they were, for the most of the last 15 years down here. And that, friends, has pretty substantial implications for investors, because in an interest rate environment that's more normal, as we are today, versus the abnormal period that we had with ultra low interest rates, that has a lot of implications for investments. So let's proceed. Same type of macro backdrop is where I think we're going to see the next financial crisis come from, is this debt issue that we have. And it's really substantial and it's really concerning, especially when we look at the servicing of that debt. No one really cared very much when interest rates were 1 or 2%, and the servicing of our debt, even though it was substantial debt at that time, the servicing of that was fairly, benign. At 5-6%, 4-5-6% in that range, it's a lot more, concerning. And that's where I think we need to realize where we're at. So one implication that is important to understand when we're thinking about higher for longer on interest rates is the lever that affects or impacts as it relates to valuation. And here's where you could see that. On the x-axis, you have the 10-year Treasury yield. We're right about here. And here's the S&P at 20-ish 1 times earnings. And as you can see, it's fairly above where the sort of, demarcation line between over and undervalued is. So this gives us some concern. If you don't know, valuation is not a great metric for, timing or short-termism for the markets. So we need to look at this with, carefully, because it does have very substantial implications over time. So we're starting at a position right now where things are elevated, valuations are elevated. They very well may stay elevated for years to come, a year or two to come. But when you look at it, when you have a wider aperture, you're looking at over 5 or 10 years, when you're doing the planning that we are doing for our clients here at ALINE Wealth, and we're looking over a period of time, it's more impactful on those back years. So we have to be cognizant of that. What I'm saying here is ignore the noise and focus on the long-term compounding of capital. This is a busy slide, so forgive me. But the idea here is that there's a lot of volatility in markets shown here by these dots. And many of those dots are down here in the red zone, -20. So you'll see that it's not unusual to have these noisy markets. Good investors and good financial advisors help their clients navigate these waters by being less emotional, more strategic, more balanced, to be able to withstand those noise periods of noisiness and volatility, because obviously the magic is the compounding of capital. So we want to make sure we stay in for a period of time where we can get that compounding. I throw copper in here because it's been on a tear recently. This is not price, this is production, and as you can see, production has been coming down. That's disconcerting because demand's going up, and that's why price has gone up so substantially. I still like copper for the long term. I think there's a very interesting thesis behind it from AI, data centers, as well as EVs. So let's watch copper. When we speak of this new regime, and we were talking about this in early 21, about how there's a new regime in town, how we believe that inflation is now stickier, interest rates higher for longer, more normalized, and those implications to investment prices and stocks especially. As you can see in the regime that we just passed, which I would say ended in 2020, we had 40 years worth of decreasing interest rates. And lots of good things happened to assets, from houses to companies to multiples to, of course, stocks. When you have the price of money, interest rates, consistently come down year after year for 40 years, everyone's partying. Any problems, they lower interest rates. Everything, any negative is swept under the rug. And the market just chugs along. Nearly 12% on the S&P over those 40 years. But if you look at the prior regime, starting in post-World War II, we had a bit of a different situation because interest rates were going up. We're coming out of the war in 1950s, consumerism in the 60s. Then you had the hyperinflation in the 70s. In that period, where we had the wind at our face rather than our back, where we were fighting an ever-increasing interest rate environment, the S&P 500 only grew at 5.7% annually. Interest rates matter, and that's the point of this slide. And so if we believe, because of the debt levels, because of the stickiness of inflation due to deglobalization, due to labor ascendancy, due to ESG policies, if we're thinking that interest rates are on the sort of ascendancy, it would suggest that we will have more difficult markets going forward for stocks. So our playbook is very much one that overweights cash. We're getting paid very nicely on cash. It provides us with a wonderful ballast to our portfolio, giving us that safety and that balance we're looking for that, frankly, fixed income cannot give us at this point, because, again, interest rates are higher and they may continue to stay higher. And, of course, cash is riskless. And it also provides us with optionality value to allow us to put capital to work when opportunities arise. So 3 reasons to have cash as an overweight in the portfolio. But of course, we're not here just to have cash in the portfolio, but also obviously growth. And there we're seeing value style dividend growth. We're looking for these high free cash flow yielding securities. We like inflation-centric sectors. We've liked them since 2021. It's worked. Real assets, infrastructure, resource companies, companies with pricing power, and again, the water sector, which we always try to talk about. Opportunities that we're seeing in today's market are like this. First off, international. It's been all US for 15, 16 years. International developed markets are cheap and they're opportunistically priced at these levels. What this shows you is that when there's been a discount to the EFA index like today, the forward returns have been very strong. And so this is where we think we are today, at a discounted EFA. And EFA being the European and international markets. So versus the United States. So we're overweighting international developed economies. We're finding great companies there, blue chip companies, companies with great dividends, trading at half the multiple of their US counterpart or peer. So opportunity. Here again, we see that in this slide with the current, PE ratios versus their 20-year median, discounted across the board. The opposite for the US and most of the world. Also, dividend stocks are oversold. And these are great companies that have increasing dividends for 20, 25 years straight, consecutively increasing their dividend. No easy task. Great companies, more of a tortoise than a hare, slow and steady. But I like slow and steady. It works. It compounds. It allows us to compound our assets for our clients. I mentioned the value style is also cheap and somewhat oversold. On this chart, we're seeing how the relative PE, forward PE versus value versus growth. So here it's pretty low compared to where it had been up here, and therefore value is much cheaper. And because of that, we're looking at the second part of this chart, which shows that over the ensuing 3, 6, 12 months, after we're getting to a oversold position, as indicated by these circles, the growth sector doesn't do as well, but boy, oh boy, does value do well. So stick with that value style. We think it's still very attractive. Now, concentration risk is big on my worry list these days. As we know, 10 stocks represent more than 34% of the S&P, comparable back to the Nifty 50 era of the early 70s, late 60s. So, be forewarned that concentration, and I think as of this week, we've hit a new high on the concentration level of the top 10 stocks on the S&P. So color me concerned in that regard. I jokingly say, "What me worry here?" I do worry when you start seeing that 10% of the stocks of the entire U.S. market it's 75%. I mean, it's gotten to a point where it's getting very narrow leadership, and this is where we are currently, and this has been the market concentration among the top 10 largest companies. So certainly one to think about and to worry about, and to start saying, maybe we should be positioning ourselves in other places besides just the S&P, or frankly, just besides the US. But I always try to bring this to the forefront. If we think we can time the market, think again. That's not what we do. We look for cheap assets. We look for great companies. We look for companies with free cash flow generation, and then we look to own those for a long period of time. We're also looking for big themes, and perhaps some of those themes can be growthier and less value-oriented, like genomics or biopharmaceutical, or even electrification in some cases. So the water theme is more value. But here, what this graph shows unequivocally is the fact that you can't really time markets, right? So here you do a Rip Van Winkle for 40 years, your 10 grand goes to almost $1 million. If you miss just 5 of the best days, and you don't know when those days are, you're down 38%. If you miss just 50 days, 50 of the best days, you're down 93%. We don't know when the next best day will be. Stay in the markets, in a core, work the asset allocation depending upon relative market conditions, but stay invested with a percentage of your portfolio and work the edges, which means put capital to work when things are down and cheap and scary, and take some stuff off the table, not all, but some, when things are overdone to the upside and markets are just, unhinged with reality. Okay, I want to thank you for your attention. Wishing you a beautiful summer. We'll speak with you next month, sure, and look forward to doing so. Thanks very much. Have a great week.